I'm John Hanna for CDTV.net in New York, and we have Greg Womack, President of Womack Investment Advisors, joining us from Edmond, Oklahoma. Good morning, Greg.
Good morning, John.
How are you today, sir?
Well, we're doing well. Just had a good weekend, but a busy Friday but with the markets, and we're busy again today. With all the uncertainty going on in Washington, so we're got our plates full right now.
Right. When you said busy last weekend today, you told me in the past that you're actively managing your clients' money, right?
Right. Yeah, we manage some individual accounts. We also have two funds that we limited partnership funds that we run, and so we're just last week or so, and coming, of course now just with the Monday before the August 2nd deadline, there's still no official deal in place. We're just kind of hedging some bets and making sure if the floodgates open on the downside that we have some protection in place.
How does one go about protecting their investments?
Well, there's several ways, John. If you're owning stocks long, you want to go in and look at a chart and try to say, okay, well, if this stock fell below its previous low of the last few months or 6 months or whatever, you want to probably put in a sell stop as one way you can do that. So you also look at like the 50-day moving average, the 200-day. So if you have a substantial gains in your stocks, you want to try to protect those gains. But then if you don't have a lot of gains, you want to protect your principal. So looking at a sell stop, which is a good to cancel order that says I want to sell XYZ Corp at $50 a share and maybe trading at $55 right now. And what that says, if that stock hits that $50 price, then it will become a market order. And so sell stops or sell stop orders are one way to do that. It's a sell stop limit to where it would not become an order until it hits that price. Another way to do that, protect your downside, would be buy a put option. If you have experience with options, and that's one of the things that we are doing, where we go in and buy a put option on a stock, say somewhere below where it's trading now, in case things fully fell apart, say over the next 6 months, you're protected at that level. Now that does cost you a premium because you're basically buying the option to put that stock to somebody at that strike price. So if your stock's trading for 55 and you say, hey, if this thing falls apart and I want it out at 50, then you buy a put option. And if that thing does fall below 50, you're in the money, and it actually gains in value. So if you paid $1,000 for that option, then it could actually start making you money. As your stock price goes down, that option price goes up and mitigates you or protects you at that $50 level. So it's though the stock were never trading below 50 once you have that option in there. But options can be very complex, so you want to make sure you go out far enough in expiration. Usually they're 1 month, at a time, and you can go out as far as 2 years if you wanted to. But you probably want to give it, at least 3 to 6 months to go out when you're buying these options. So because if you don't, if your option you bought at 50 does not hit that 50 and you're not in the money on that option, then it starts to deteriorate and you have to get out of that option, or you'll give up all the premiums that you paid for it. So a lot of complexities there, but that is something that we do, and it helps protect us at a certain level on the market or on individual securities.
There you go. That's Greg Womack, President of Womack Investment Advisors, joining us from Edmond, Oklahoma. And I'm John Hanna for CDTV.net in New York.